Okay, so welcome to today's first lecture in the Introduction to Banking. After these preliminary information on the course and the general outline of the class, let's start with an introduction and some basic characteristics of the German banking system. I'm pretty sure most of you know some of these details I'll be giving you in the next couple of moments, but especially if you are an Erasmus or exchange students, you probably will not know too much about the German banking sector. And we'll start by trying to define what is a bank, because everyone will have a vague idea about what a bank is, but we'll see that actually in many cases what you think is a bank might be a financial service agent, and in some cases a company that offers special financial services is actually competing in the financial sector as a bank. So it makes sense to define this term bank, and in general, and we'll see this later on in the legal definition, in general, banks are companies that take on deposits. In German, same word, Depositen, Einlagen, also letztlich das, was auf dem Sparbuch liegt. And they grant loans. And this is what banking in its most traditional form is. Taking in deposits by customers and giving out and granting loans to borrowers who need capital. And the problem now is that this definition, a company that engages in lending and deposit taking, this definition of course only applies to a subset of banks, because there are some banks that do not grant loans, they do not take in deposits, but they are also considered banks. And why is that? They offer additional banking services. For example, investment banking is one example for this. So this is not the best way to define a bank. Also, banks in many cases offer similar services and have similar functions as financial markets, and they compete with other financial industries and financial companies in a number of ways. So it does make sense to first define the objectives and functions of financial markets in general. What is a financial market? A financial market is a market on which financial contracts are traded. What are financial contracts? In German, the same word, Finanzverträge. Financial contracts represent claims to present or future payments. Why do we choose such a general definition? Because most of the theoretical foundations of banking are very general. They do not look at special banks, at investment banks, but they just look at financial intermediaries. That could also be an insurance company or a bank. And in these models, the basic good that is traded is a financial contract. They do not need to make distinction between this type of loan or this type of loan. They start and they stop at a general financial contract. And a financial contract simply represents a claim to a present or future payment. That could be a loan, that could be a deposit, it could be an option contract, it could be anything. Okay. So in simple terms, financial markets are the place where lenders and borrowers meet. Some agents have capital, some other agents need capital. And in a financial market, borrowers and lenders of capital meet, and they agree on a price that is usually an interest rate, and they will exchange payments. So this is a financial market. Now, knowing this, it becomes clear that banks and financial markets actually fulfill similar functions. In a financial market, like for example a stock exchange, you as traders would enter the stock exchange, the stock market. You want to buy a stock, you want to sell a stock, you will exchange payments, you will exchange capital, you will trade financial contracts, and this is done on a financial market. But if you, for example, as a customer have capital, you can also go to a bank, you can leave the capital at the bank, and the bank will use this capital to give out loans. Similar function. So What do we do? In contrast to a trading platform, that would be, for example, the stock exchange, there's one difference between a financial market and a bank. The bank itself appears as a market participant. It can, for example, on its own, buy and sell stocks. It can originate bonds and other financial securities. And it will engage as a market participant, and it will not simply appear as a trading platform. And because we can see that financial markets, financial servicing agents and banks fulfill similar functions, we try to distinguish between and differentiate between financial intermediaries in the strict and in the broader sense. In the strict sense, a financial intermediary is an institution, a company that receives capital from lenders and passes it on to borrowers, for example, banks, but also insurers, venture capital funds, and other financial agents. In a broader sense, a financial intermediary only makes trading financial contracts possible or easier. So, for example, a stock exchange is a financial intermediary in a broader sense because it only facilitates trading. It doesn't engage in financial contracts itself. It doesn't pass on capital. It simply facilitates the trading of other agents. So this is a financial intermediary in the broader sense. A bank, but also an insurance company or a venture capital fund, that is a financial intermediary in a stricter sense. By the way, now you can see that banking, which is more on the business side, is closely related to financial economics, but also financial intermediation, which is more related to economics. And you might have seen that we do have financial intermediation classes, but it's offered by Professor Vollmer in our economics section, whereas this class, as you might know, is offered here in the business section. As you can see, some of the graphs are still in German, and I'll apologize for that. And these will be updated over the course of the class, but it'll take us a couple of weeks. But you can see here, these are the tasks of a financial intermediary. You have lenders on the upper left side, you have borrowers on the upper right side, and you have a bank. And the bank is now introduced into this relation between the borrowers and the lenders. This is why we call them a financial intermediary. It intermediates between borrowers and lenders. And what do they do? Usually, if you have a look at the balance sheet of borrowers, lenders, and the bank, the lenders, they will have some assets and some equity. They will give some of their equity, some of their capital to the bank. The bank will accept this capital as a source of financing, and then it will give out loans to the borrowers on the upper right side. One important feature of a bank can already be seen from this slide. If you ever take a look at the balance sheet of a bank, it will slightly surprise you because loans will appear on the left-hand side, on the asset side of the liability sheet, on the balance sheet. Why? Usually the balance sheet will look like this. If you are an industrial company, for example, this perfume store, you will have some assets. For example, you will have bought perfume, you will have inventory. So this is inventory, and you will have some cash, and you will have some loans and equity here. So debt and equity on the liability side of the balance sheet, and inventory, cash, maybe some other assets like a car or some stores, real estate on the asset side. For a bank, it's switched. The bank will give out the loans. So the loans will go to the asset side, and if the bank accepts deposits, the deposits will be a source of financing on the liability side of the balance sheet. So don't be surprised if you see loans on the asset side of a bank's balance sheet. No? Okay. Now, we have seen that a bank is a financial intermediary. Actually, it's a financial intermediary in the strict sense because it facilitates financial contracts and it also enters financial contracts with borrowers and lenders. Now, a very naive but also a very simple way to define a bank is just to have a look at the legal statutes, at the laws that in Germany govern the banking sector. In Germany, it's the so-called KWG, or in German KWG. It's the Kreditwesengesetz. This is a part where it is a little bit difficult for me to talk about this in English because, well, it doesn't make too much sense to take the German laws and to translate it into English. We've tried to do this, but again, because if you are interested in detail in this, you will have to look at the German laws in their original. The KWG, the Kreditwesengesetz, is the basic law that is relevant for all banks, and it includes almost all the necessary statutes on banking business in Germany. Now, how does the KWG define banks? Quite simply, in paragraph 1, section 1, sentence 1, so at the very first start of the German Banking Act, it says, credit institutions are companies that conduct banking operations commercially or on a scale which requires commercially organized business operations. Same in German. Bank ist ein Unternehmen, das Bankgeschäfte durchführt und das entsprechend kommerziell oder in einer Art und Weise, so dass es eine handelsübliche Einrichtung erforderlich macht. So, that is a bank under German law, meaning that we can have an academic discussion on what is a financial intermediary, what is a financial intermediary in the broader or strict sense. When it comes to the legal system, it's quite clear. The law is strict at this point. If you conduct banking business, you are a bank under the German law. And next, paragraph 1, section 1, sentence 2, fully lists all types of banking businesses. So if you start a company and if you engage in any of the following banking operations, you fall under the German Banking Act and you are considered a bank. First thing is deposit business, Einlagengeschäft. Acceptance of funds from others as deposits or unconditionally repayable funds from public unless the claim to repayment is securitized in the form of bearer or order bonds, irrespective of whether or not interest is paid. In other words, if you accept deposits, you're a bank, full stop, no discussion. And then it goes on. Pfandbriefgeschäft, Pfandbrief business. You cannot translate Pfandbrief. This is a very special type of bond that I think is only common in Germany. A Pfandbrief is an interest-bearing security issued by a mortgage bank next to the solvency of the issuing bank. In case of insolvency, there are also additional collaterals. It's a type of bond, so it's debt, but in addition to the default risk, in addition to the issuing company, you also have additional collaterals. For example, what is very common are real estate Pfandbriefe, meaning that this Pfandbriefbank issues such a bond, and in case the bank defaults, the bond is not worthless, but you are able to use specifically designated real estate assets as additional collateral. So this type of bond is usually very secure and almost close to, default risk is close to zero. A funny anecdote on the side. Does anyone know when Pfandbriefe became infamously known in Germany? Usually, if I ever bring any anecdotes or stories from the past, it's from the financial crisis of 2008 and 2010. During the financial crisis, there was one famous German bank that was heavily invested in securitized loans and had to write off those loans in the billions of euros. And it faced bankruptcy. The problem was that this bank, does anyone know which bank I'm referring to? Yeah?
It's Deutsche Bank. Deutsche Bank.
Deutsche Bank? No. Pfandbrief.
HSH.
HSH? No. And it's not IKB, but the other famous German bank that almost bankrupted during the financial crisis. Hypo Real Estate. And the name already suggests what they did. Hypo Real Estate was and is one of the largest market players in the market for these types of bonds. And they were not systemically relevant because of their banking business. But if Hypo Real Estate had been allowed to fail during the financial crisis, the German government feared that the market for this type of bonds that everyone suspected to be near risk-free, without any default risk, this market for this type of bond might have gotten into trouble, so they bailed out Hypo Real Estate. And what they usually do is, in this type of bonds, you have the bond issuing bank plus additional collaterals that guarantee repayment of this bond. And this is Pfandbrief. These are Pfandbriefe. If you enter this type of business, you're a bank. Credit business, granting of money loans and acceptance credits, bank. Discount business, purchase of bills of exchange and checks. Principal broking, that should be brokering services. Purchase and sale of financial instruments in the credit institution's own name for the account of others. And so on and so on. And you can see the list is long. Some more interesting things. E-money business has been repealed. Underwriting business, check collection, guarantee business, investment business has also been repealed. Safe custody business. All types of banking operations. All of these banking operations are listed in paragraph 1 of the German Banking Act. And if your company starts to offer these services, you are a bank. And we don't need to have any further discussion. One would think that this is a very boring subject. It usually is, because all those banks you probably know, Deutsche Bank, Commerzbank, there is no discussion that these fall under the German Banking Act. But this paragraph 1, section 2, is quite interesting and has become quite interesting for many companies over the last couple of years. Do you know why? Because this is quite pivotal for fintech companies. If you are a fintech, and in some cases, fintech companies start with like 5 employees. If you start with 5 buddies from university and you start your own fintech company, you have to decide on what type of service you are offering and make sure that either you want to be considered as a bank, or you want to make sure that under no circumstance you could be considered a bank. Because as soon as you are considered to be a bank, you fall under the supervision of the German Federal Financial Supervisory Agency, and you will have regulatory costs. Yeah? So for fintech companies, this is quite relevant because they have to decide, do we want to be a bank, or do we want to prevent being considered a bank and to fall under the supervision of BaFin? Yeah? Okay. Now, there are some further distinctions. For example, in paragraph 1, section 3d, sentence 1, some credit institutions are further defined as so-called Einlagen, Kreditgeschäft, an Einlageninstitut. Deposit-taking bank, the German word is Einlageninstitut. Quite simply, if you operate financial commission business as well as credit business, if you take on deposits, you are a deposit-taking bank. You are an Einlageninstitut. Sometimes you also have Wertpapierhandelsbank, securities trading bank, or e-money institution, E-Geld Institut. Why are these distinctions made? The first thing here, the deposit-taking bank. Does anyone know what the colloquial word for this type of bank is in German? No, Sparkasse is a type of Einlageninstitut. Any idea? This is something you read from time to time in newspapers. This is what is called colloquially the Vollbanklizenz, meaning that this is the type of bank that faces the toughest supervision, and you are allowed to operate any type of banking business. So this is the trade-off. If you want to do everything, deposit taking, investment banking, e-money business, etc., you will need a license to be a full bank, to offer full services. In German, Vollbanklizenz, Lizenz, license, and Vollbank is full bank, full service bank. Why is this attached to deposit taking? Because the government says that the part in banking that needs the toughest supervision is deposit taking. If customers go to a bank and rely on the safety of their deposits, this is the part of the banking business that requires the toughest supervision and regulation. So if you want to engage in deposit taking, the government says, okay, then you face the toughest supervision, but if you are able to do deposit taking, you're allowed to do any other type of banking business. The opposite can be seen here. If you are a small company and you only operate in e-money business, and I'm not talking about Bitcoin or something like that, but I'm talking about saving and storing money on a chip card at a Sparkasse. This is an e-money institution, and supervision is much less strict for those companies than for a deposit-taking bank. Okay, and similarly for a securities trading company. Okay. Now, under German law, the terms bank, banker, and savings bank, Sparkasse, they are legally protected by paragraphs 39 and 40 of the German Banking Act. And if you choose to take up such a name in your company title, you need a license by the German Federal Financial Supervisory Agency, BaFin. BaFin stands for Bundesanstalt für Finanzdienstleistungsaufsicht. It's a federal agency because in this case the supervision, there are some parts that are also delegated to the Länder, to the states, but usually the supervision of the financial markets is a federal subject, so it's done on the federal level in Germany. BaFin gives out licenses to conduct banking business, and you need such a license to operate as a bank in Germany. It's similarly in other countries. I think in any developed country you will need to be allowed to offer banking services by some type of financial supervisory agency, or in many countries the financial supervision is done by the central bank. So you do not have a central bank and a separate supervisory agency, but you have just one central bank. The terms credit union, Volksbank in German, also savings and loan banks, Spar- und Darlehenskassen, they are also protected under law, and they may only be used by credit institutions operating in the legal form of a registered cooperative society or a mutual union, a credit union. This is, and also they need to belong to a Prüfungsverband in German, to an audit association. What does it mean? In a couple of slides, in a couple of minutes, we'll see that in Germany you have three major pillars in the banking system. Sparkassen, Volks- und Raiffeisenbanken, and private banks. Now, private banks is quite simple. You have, for example, Deutsche Bank, Commerzbank, Targo Bank, Santander Bank. Those are private banks owned by stockholders, sometimes also by the state in the case of Commerzbank, but those are private banks. The Volks- and Raiffeisenbanken, those are credit unions. And this is a very socialistic type of business. In credit unions or mutual corporations, in these cooperative societies, they share the similarity that customers are stockholders and stockholders need to be customers. And every customer has the same share in the company. So if you go to a Volksbank, the same actually with some types of insurance companies, if you go to a Volksbank and you want to open an account, you have to become a shareholder. And you will have to buy a share, let's say for 20 euros, but you cannot buy more shares. Every customer has the same share in the bank, and this is the defining property of a Volksbank, of a cooperative bank. And Sparkasse, savings banks, this is quite simple. Sparkassen, they belong to the state or usually to the cities and municipalities, Stadt und Kreise. Let me ask the Erasmus students, do you know a little bit about the organization of the German state into cities, Kreise, counties, states? Not really. Okay, the German state is organized into federal states. For example, we are in the state of Saxony. You have Bavaria, North Rhine-Westphalia, Berlin, Bremen. Some 3 cities, Hamburg, Bremen, and Berlin, they also form a state, but that has historic reasons. So you have a state, and each state is organized into counties, and those counties are called Kreise. And each Kreis, each county consists of one or many smaller cities. Leipzig, for example, is what we call a county-free city. It forms its own county because it's so large. But if you leave Leipzig and go to the outskirts, you will see that you have some, you can see it on the license plates of the cars, you can see the counties. And Sparkassen, they belong to a city or a county. And you can see that in the name. For example, you have Stadt Sparkasse Leipzig, and in some cases you have Kreissparkasse or Stadt- und Kreissparkasse. And the title and the name of the bank already hints at whether the Sparkasse is in the ownership of the Kreis, the county, or the city. Yeah, and these are the 3 pillars. Sparkassen, state-owned banks, cooperative banks, and private banks. And they compete in the same market, and they don't really have, they have no special rights. They compete in the same market, more or less. Okay. Some other types of banking names are also protected. For example, a building society, Bausparkasse, and investment companies. You cannot simply, I usually bring this example of Lucy with the Peanuts. You might know the comic strips, Peanuts, and you know that Lucy in many strips opens her own stand where she offers psychological advice. And you cannot do this in banking. Same in psychology, I would assume, but in banking you cannot open a company and say, I will open an investment company. An investment company, the name is protected, and as soon as you start offering services under the name of an investment company, you are a bank, you fall under the supervision of BaFin, and you need a permit to operate these services. Same with the Bausparkasse. Does everyone know what a Bausparkasse or a building society is? Who does not know what a building society is? Okay. A building society is a company where you enter as customers, you bring in deposits, and you start to save money. And you save your deposits. Interest is paid on this deposit, and the contract goes like this. You bring in deposits, and after, say, 10 years of paying deposits into your account, you will get a loan to build a house, for example. That's why it's called a building society. It's also a type of usually it's a cooperative society. And what is the advantage of such a building society? You pay in and you save money, you save capital in your building society, and after you have paid in to your account, you will get a loan for building a house, but at a lower interest rate, at a cheaper interest rate than you would get at a bank. So it's a trade-off, and it's a deal you make that you pay in to this building society, you save money, you save capital, and later on you will get a loan for building a house at a cheaper rate. And it works a little bit like a Ponzi scheme. Does everyone know what a Ponzi scheme is? In German Schneeballsystem. A Ponzi scheme is, for example, I'm a company and I accept money from you three students, and I will pay out money to you by the money I'm taking in from these, let's say, 10 students. So I'm getting money, I'm giving you your money back from the money I'm taking in from the next set of customers. This is what a Ponzi scheme is. A Ponzi scheme, Schneeballsystem in German, it might be legal, it might be illegal. But actually here, it works a little bit like this. You start with a set of customers, they pay into this building society, and after 10 years, they want to get a loan. And how do you finance this loan? By taking the money the next customers are regularly paying into the building society. So it is a special construction of a saving scheme, and this is why it needs supervision. Something could go wrong with a building society, and you need to guarantee that those deposits are paid out later on. This is why they are, and Bausparkasse, why these terms are protected under law and why this is considered to be a bank. And last but not least, you also have financial service institutions, Finanzdienstleistungsunternehmen, und Finanzunternehmen, financial companies. Financial service institutions, Finanzdienstleistungsunternehmen, are companies which provide financial services and which are not credit institutions. For example, proprietary trading, foreign currency dealing, investment brokering, operation of a multilateral trading facility, that is a stock exchange, Deutsche Börse. Those are not considered to be banks, but they are still considered to be financial service companies, and they fall under the supervision of BaFin. And finally, financial companies, Finanzunternehmen, those are companies which are not credit institutions, investment management companies, or externally managed investment companies, and whose principal activity involves activities listed in Section 3 of Paragraph 1 German Banking Act. Acquiring and holding ownership interests, leasing, very important, trading in financial instruments for our own account, advising others on investing in financial instruments, etc. So why do we need financial service agencies and financial service companies and financial companies? Simple reason. The German state, the German government, as any government, wants to make sure that as soon as you start fiddling in the financial market, you are supervised to the necessary extent. And as soon as you start around telling people, I can advise you on stock trading, you need to be supervised, because especially the examples from the United States have taught us that a lot of mischief can be done with financial securities and financial payments in general. So the government wants to make sure that as soon as you enter the financial market, you are supervised to the necessary extent. So if you are only acting as an advisor, if you are a leasing company, for example, a car company that offers leasing contracts, you should not suffer the full extent of financial supervision, but you still need to be supervised to some extent. So this is why we have financial companies. as the lowest type of supervised company in the financial sector. If you offer more services, you are a financial service company. If you offer banking services, you are a bank. And if you offer deposit taking, you have a fully operating license, you are a deposit taking institution, you are an Einlageninstitut in German. So these are the different types of financial companies and banks German Banking Act distinguishes and differentiates between. And the reason usually is different levels of supervision, and different discretion when it comes to financial supervision and regulation. There are also other types of banks that are mentioned in the German Banking Act. I don't want to go into these types, but I want to refer to this type of financial company. Bank assurance. Bank assurance is a fixed term that is used for the combination of a bank with an insurance company. If a company offers insurance services and banking services, in English it's what we call bank assurance. It's a bank assurance company. In German it's Allfinanz. And if you ever see this word Allfinanz, it's referring to the fact that a company offers both insurance and banking services. By the way, do you know the last example or some examples of bank insurance companies in Germany? One famous failed example is the takeover and merger of Allianz with Dresdner Bank, and later on the sell-off of Dresdner to Commerzbank after Allianz realized that it's not working. So the largest German insurance company bought one of the largest private banks, Dresdner Bank, and it didn't work out. They hoped that they would be able to use and get a lot of synergy effects. Didn't work out. Usually nowadays, most banks also offer some insurance contracts. Not all, but in some, at least they are acting on behalf of an insurance company. One example is Postbank, Deutsche Postbank. They also offer insurance contracts, but I would assume that they only sell insurance contracts from other insurance companies, and they are not a fully integrated bank assurance company. Do you know how it works with the Sparkassen and Volksbanken? No? Any ideas?
The Volksbank is working together with the RNV.
Yeah.
And the Berater in the Volksbank can sell some of the insurances.
Yeah.
But not all. There are special insurance Berater from the RNV for special cases.
Yeah. Mm-hmm. And does anyone know how it works in the Sparkassen? We'll later on talk a little bit more about these two sectors, and two pillars of the German banking sector: the Sparkassen, the savings and loan associations, and the credit unions, because they are very, very specific to Germany. I've already mentioned that the Sparkassen are state-owned banks by the municipalities, by the counties or the cities, but meaning that they are very small. No? But they are organized at the state levels, at the regional levels, and at the federal level. And at the federal level, they have an organization, DSGV, the German Savings Banks Association, Deutsche Sparkassen Giroverband. The DSGV, this is the organization, the association at the federal level that organizes meetings, joint standards, risk management tools, IT. They also have subsidiaries that are responsible for rolling out the same methods, the same IT, the same standards across all the banks in this pillar of state-owned banks, in the Sparkassen. And they also have insurance companies. For example, Provinzial is one type of insurance company that is owned by the state-owned banks, by the Sparkassen. Here, I think, for example, in Halle, we have the ÖSA. No? So this is an insurance company that is more or less owned by the savings banks, by the state-owned savings banks, and the Sparkassen, they offer insurance contracts made out by the internal insurance company. And with the Volksbanken, the credit unions, it's just one company, it's R&V Versicherung, R&V Insurance, and they offer insurance contracts that are being sold in the offices and branches of the credit unions in the whole of Germany. So although it's not really bank insurance, insurance contracts are of course nowadays sold off in bank branches. Okay. Now these are some ways of defining what a bank is. A legal definition, a more academic definition, financial intermediary. Now let's turn to the question, what functions do banks fulfill? One way to define the term banks is to show in which ways financial intermediaries exceed financial markets in fulfilling market functions. We've seen that banks do something similar than stock exchange or a market facilitator, a trading facilitator. And it makes sense to look at the different functions, the market functions that financial intermediaries fulfill, and to see and to explain why banks are able to offer these services and fulfill these functions in a better way than other market participants. Now, what are market functions here? A financial market has several important functions. Coordination, allocation, and selection. Lot size transformation, maturity transformation, and risk transformation. In German, Losgrößentransformation, Fristigkeitstransformation und Risikotransformation und dazu natürlich Auswahl- und Allokations- und Koordinierungsfunktion des Marktes. What does it mean? Any idea what these functions are? Perhaps with the example of a bank, yeah.
So, for example, banks borrow money on the short term and lend money on the long term. It's a maturity transformation.
Yeah, banks, that is quite famous, banks engage in maturity transformation, Fristigkeitstransformation. What is meant by this? It means that traditionally banks take in short-term deposits. So if you look at the asset and liability side of the balance sheet, they have a very short-term financing because here they have deposits. And even if you leave your money for a longer period of time at the bank, you can go to the bank at any point in time and reclaim your deposits. So it's short-term financing. And they give out loans that are long-term. And in normal times, with normal interest rates, without any additional information, you could just say, we are paying out 2% interest on our deposits, and we are accepting 5% and taking 5% on our loans. And simply by taking in many small deposits and transforming it into one long-term loan, you can achieve a difference in the interest rate you pay on your financing and on your assets. And you make money. In this case, 3%. This is also one reason why we usually refer to the balance sheet of a bank to be quite fragile, and the fragility of maturity matching and maturity mismatch. Why? It could always happen that, let's assume I open a bank. You are my customers and you come to me and you give me your deposits. Everyone gives me 100 euros. I can give out a loan of say 5,000, 6,000 euros. But if you start to run to me and you demand repayment, I as a bank, I am bankrupt. Because I've given out a loan, I've used your 5,000 to 6,000 euros as a loan with a maturity of say 5 years, and I will only get back your money after 5 years. But my financing is fragile because you can reclaim your payments at any point in time, and I have to make sure that I have enough cash to pay out the customers who want to reclaim their deposits. So the balance sheet and the liability side of a bank is always, by definition, very fragile, and the funding structure of a bank is fragile. And we have a maturity mismatch. Short-term financing on the liability side, long-term investment on the asset side. So this is maturity transformation. Lot size transformation, Losgrößentransformation. I've already explained that on the fly just a couple of sentences ago. I accept a lot of small deposits and I transform it into one large loan. Lot size transformation. Small loans are small deposits and small amounts of capital are transformed into one larger loan. Risk transformation. What is meant by risk transformation? Well, you want to invest your money risk-free. You want to bring your money to the bank. You want to get 1%, but you want it to be risk-free. And I'm faced with customers who are in need of capital, but they have risky projects, who want to buy a house, who want to finance a machine in a company. And then this investment for the bank is riskier than the deposits. So usually you have risk-free financing or investors, depositors, who want their investments to be risk-free, and the bank who invests it in a risky way. And this is how risk is transformed. And also, what the bank does is it takes in many deposits and gives out many loans. And especially on the asset side, it gives out a loan to a private person who is risk-free, to a company who is a little bit risky, to a company with a very risky project. And by diversification on its asset side, it transforms the risk of the portfolio of all those investments. This is how risk transformation is done by the bank. Also, one very important feature here. This, what we are talking about right now, we will later on see all of this in the banking theories, for example, in the Diamond model. And at this point, make sure to note that if you go to a bank and you deposit capital in your savings account, you are an investor. You invest in the bank. Later on in these theoretical models, we will not talk about deposits or loans. We will only talk about investors who want money or who need money and capital, and financial contracts. And those models will be very general in nature, but of course, it will always be exemplified by investors in a bank. And although you are bringing the money to your bank and you have a savings account, make sure to remember that if you are a depositor, if you are a customer with a savings account or a checking account with a bank, you are an investor. You invest debt, because you are financing the activities of the bank. And if you take out a loan, well, you are an entrepreneur who requires capital, and then the bank is the investor in the company. And it's always debt. Okay. Coordination, allocation, selection, that's quite simple. Coordination, banks and financial markets in general help market participants find each other. They help coordinate the trading between market participants. Allocation. The financial markets allow for the efficient allocation of scarce resources. In this case, it's funds or capital. How does it make the trading more efficient? Financial markets, and it's also related to selection. Financial markets select and flag those investment projects that are most likely to succeed. And in this way, capital, which is a scarce resource, is allocated in a very efficient way. So this is one function of a financial market. Efficient allocation of capital to the best projects, to the best investment projects. And selection, this is also done by banks. Do you know how the bank selects market participants? A bank helps to select participants to enter the financial markets or not to be allowed to enter the financial market. Very simple example. If you are not credit worthy and you go to a bank and you want a loan, and risk management in the bank says, no, this person is not credit worthy, he or she will default on the loan, you will not get a loan. And you are restricted from entering the financial sector in this way. It's a very simple example of how banks help select market participants and limit access to financial markets. Okay, we've already talked about lot size and maturity transformation. This is quite simple. Risk transformation, again, it's done by transforming the risk of the capital invested via deposits and the capital invested by the bank via loans, but it is also done by diversifying in the portfolio of the bank on its asset side. And these are the functions that banks and financial markets fulfill. Now, in addition to these abstract functions of financial markets, banks also fulfill additional important functions for an economy. For example, the supply and creation of money. Banks do not only match borrowers with lenders within a zero-sum game, so capital comes in and capital goes out in the same amount as in a zero-sum game, but banks also create commercial bank money. In German, it's Giralgeld. Within the banking sector and creating additional forms and additional possibilities for credit. How is this done? Has anyone of you ever seen this, maybe in economics class? The creation of central bank money or of commercial bank money? No one. Okay. We will later on see this. It's quite simple. If you take in, for example, 100 euros of deposits, and this you can, very simple example. First of all, you can grant a line of credit to your customers. Then your customers have a credit line and they can use it. And they cannot use it and they are not forced to use it. So this is one thing. And what is regularly done by commercial banks is that you have a claim on cash or cash equivalents, and this is created by cashless account-to-account transactions. For example, if you have account-to-account transactions, also in German Giral und Buch, how you call it, bargeldlose Überweisung, so, cashless account-to-account transactions. Commercial bank is created by placing central bank money into deposit accounts or by commercial banks making loans. And this is due to the fact that a bank takes in deposits or central bank money and it can give out loans, but it only needs to keep a certain fraction of the loans, for example, in equity on its liability side. So it can give out more loans than it actually has capital because it needs to keep a lower percentage of loans as a reserve. And this percentage, we'll later on learn a little bit more about this when we talk about central banks, this percentage number the bank needs to keep in reserves when it gives out loan. This percentage number governs the creation of commercial bank money in an economy. So by using cashless account-to-account transactions, you can increase the supply of money in an economy. And also banks, of course, provide liquidity by investment services and they facilitate money transfers and cash transfers. This is usually one of many reasons why banks are considered to be systemically relevant. Now, up to this point, I've talked a lot about why and when banks are supervised and when companies are supervised. I haven't talked about the question, why are banks supervised in the first place? The first and utmost reason for financial supervision is the stability of the financial sector and thus the stability of the economy as a whole. If you suddenly let all of the financial sector go bankrupt, there will be no companies that do what? Give out loans. Lending and giving out loans is one fundamental ingredient you need for an economy, for an industrialized economy to work. So if lending is left out of the picture, economic growth will stop and you will enter a recession. So lending is important. But then, of course, facilitating bank and money transfers. This is one of the most important features and functions of a bank. Zahlungsverkehr in German. Banks offer, and even if they don't make money, don't even earn money by offering these services, it's a fundamental part of the financial sector and critical for the functioning of an economy. If, for example, tomorrow there would be no banks, and if you don't need to put your deposit somewhere, if you don't need a loan, everything's okay. But if you need to withdraw cash from an ATM, or if you have to pay your rent in an account-to-account transaction, you need a bank. So facilitating money transfers, this is one reason, or first of all, this is one thing banks do, and this is one reason why banks are systemically relevant. Zahlungsverkehr and facilitating lending and offering lending services so that companies can get loans to invest. Otherwise, banks would not be systemically relevant. And this is quite interesting to see that if you think of fintech startups that try to attack banks, what do you think are they offering? What is the unique selling proposition of many fintech companies that try to attack banks? First of all, usually the unique selling proposition is helping banks to offer any of these services a little bit faster, a little bit better than they do now. But in many cases, it evolves around this. Cash transfer, Zahlungsverkehr. Because this is the one part where actually you do not need a full grown-up and full-grown bank with thousands of employees. You just need a computer and some IT specialists to offer financial services here when it comes to cash transfers nowadays in a digitalized world. This is where many fintech companies try to attack banks and to compete with banks. And do you have an idea who probably is the largest competitor to banks, to traditional banks? Yeah?
PayPal?
Yeah. PayPal, Apple Pay, Amazon, Google. All those large IT companies are trying to get this business from banks. Why? First of all, banks have neglected it for years and decades. They thought that this is the worst and most boring part of banking. And IT companies have realized that this actually is the most interesting part in banking. Why? Because you get data. You get data on transactions, and by looking at money transactions and cash transactions of customers, you know what they want. You know what they buy. You can assess what and infer what they are not buying. You have a profile where they are buying things, from which companies, and this is worth a lot. Yeah? This is why PayPal, Amazon, and every tech company is trying to get into financial payments and services here. Okay. Another very important distinction between banks can be made between commercial banks and investment banks. And I always stress this because I have to tell you that when I studied business back 17 years ago, I had no clue what an investment bank was. I remember going to fairs for students, for internships, and companies like Morgan Stanley and JP Morgan piling up and telling me as a small student, young student, what great opportunities lie in investment banking, and I didn't have a clue what an investment bank actually does. Now, I don't want to, I want to spare you the embarrassment I had to suffer that I didn't knew what an investment bank is. Commercial banking, usually referred to as traditional banking, is simply deposit taking and lending. So the type of business, for example, a Sparkasse does, taking in deposits, giving out loans, that is traditional banking, commercial banking. Investment banking, on the other side, on the other hand, includes all services concerning commercial asset management, trading activities, and raising capitals. In other words, this is B2C, business to customer. This usually is business to business, related to financing companies and investment decisions by companies. It can sometimes include lending, commercial loans, business loans, but usually loans will be here. And every time a company wants to do an IPO, it needs equity, it needs debt, it needs to issue a bond, it needs to issue new capital, new equity. If it wants to buy stocks, this is where the advisory services of an investment bank are needed. So every time a bank offers services concerning commercial asset management, trading, and raising or placing capital, debt or equity, this is what an investment bank does. Yeah? Okay. So an investment bank is a financial institution that helps their clients, aka institutional investors, large companies, with wealth management, raising capital, trading securities. And in contrast to commercial banks, they do not take deposits and usually don't give out loans. In investment banking, we can usually differentiate between the buy side and the sell side. What is the buy side? Is the side of the financial market that buys and invests large portions of securities for the purpose of money or fund management. If you advise companies regarding future investments, if you securitize stocks or financial payments, and if you sell engineered financial products to the investment bank's clients, other insurers, banks, asset managers, etc., this is the buy side. So this is where investment is done. And on the sell side, is the other side of the financial market, which deals with the creation, promotion, and selling of traded securities to the public. So you're not trying to sell it to your customers, but you're trying to sell it on behalf of your customers to the public. And here you have securities trading, market making, underwriting, marketing in an IPO, research. It's a lot. For example, investment analysts. If you ever hear that that there are analysts who tell, for example, I consider the stock of Deutsche Bank buy or strong buy. This is an investment analyst, a stock analyst, that is employed by an investment bank, and investment banks have large research departments that follow companies and advise customers on buying or selling stocks. So this is research. Market making means that investment banks stand ready to buy or sell stocks. So they are offering services just like a stock exchange, but they are offering to buy or sell certain stocks. And this is meant by providing bid and ask prices to keep the securities market liquid. Does everyone know what a bid and ask price is? Bid and ask price, in German Geldkurs, Briefkurs. Bid ask price are the prices at which you can buy and sell a security. And if, for example, you have a stock that trades at 199.3, you will have a bid-ask spread, a difference between two prices usually referred to as a spread. You will have a bid-ask spread of 70 cents, meaning this stock is very liquid. Now let's take this pen here. Assume I've bought it for 20 euros and it's new, it's still new. How much would you pay for this? Well, there is no market for this pen. It's not very liquid, and you will not buy it from me for 20 euros. You will only buy it, let's say, for 10 euros. So there will be a bid-ask spread of 10 euros, and the bigger the spread is, the more illiquid the security or the good is. And if a company offers bid and ask prices, it increases market liquidity by offering these prices. So you can sell and buy this security at any time. This is a commercial and investment bank. Historically, banking systems have either been a universal banking system or a separate banking system, Universalbankensystem oder Trennbankensystem, meaning that in some countries, banks are not allowed to offer commercial and investment banking at the same time. They have to choose to be a commercial bank or an investment bank. This used to be the case in the US. Nowadays, it's again a universal banking system. In Germany, it's also a universal banking system. Deutsche Bank, for example, is a commercial bank and an investment bank. It can offer both. But because investment banking is much more risky than commercial banking, several governments have chosen to force banks to decide and to choose between commercial or investment banking. They don't want investment banking, the risky side of banking, to be subsidized and financed by deposits. Because if investment banking loses money, the bank might use money and capital from deposit taking and from deposits to finance those risky investments in their investment bank. So this is a universal banking system versus a separate banking system, and usually if you are in a separate banking system, you have to decide whether you want to be an investment bank or a commercial bank. Okay, now I think I've talked a lot about the differences now between commercial banks, investment banks, about the different definitions of banking, and because I've used up all my time now, I will stop here. Do you have any questions concerning the definitions of banks, the distinction between commercial and investment banking? Okay, if you do not have any questions, then thank you for your attention and see you next week. Thank you.